Hello, this is Hussein Hamza, and in this video, we're gonna talk about leases. A lease is a contractual agreement between a lessor who transfers the right to use an asset to the lessee and a lessee who agrees to pay periodic rents over a specified time. So, today, we're gonna concentrate on the lessee's perspective. The lessee is the man who pays money to use that asset. The lease can be operating lease or capital lease. I'm gonna give you just a little example about the difference between operating lease and capital lease. Um, if we have an asset, its useful life is its economic useful life is 10 years, and we're leasing that asset for 2 or 3 or 4 years. So you're just leasing it for about 40% or 30% from its economic life, so it's an operating lease. But if you're leasing that asset for about 80% or 90% of its useful life, so you are the man who's making the most advantage from using that asset. So it's a capital lease then, okay? Of course, the capital lease has more than condition. Um, there is about four conditions. One of them must be met to be able to say that this is a capital lease. One of them is that the ownership at the end of the lease will be transferred to the lessee. So it's a capital lease. But in operating lease, there is no transfer of ownership or any risk or benefit of ownership. Also, if there is a written option um, for the lessee to buy that asset at the end of the lease, so it's a capital lease. And there is 90% rule and 75% rule. In the lease, in the capital lease, we do some present value calculations. So we say if the present value of um, the future payments equals the is greater than or equals 90% of the fair value of the asset, so it's a capital lease. And also 75% rule, if the lease term is greater than or equal 75% of the economic life of the asset, so it's a capital lease. We're gonna discuss the capital lease later because today we're gonna concentrate on operating lease. So let's read what we have here. An operating lease, an operating lease includes a lessor and a lessee. The one who collects rent is the lessor, and the one who uses the leased asset and pays periodic rent for such a use is the lessee. In operating lease, the lessee merely uses the asset. So he's just using the asset for a specified time, and he will give he will give the asset back to the lessor, to the owner of that asset. In operating lease, there is no transfer of ownership or any risk or benefit of ownership. Operating lease has a lessee's perspective and lessor perspective. Today, we're going to concentrate on the lessee's perspective. The lessee records rent expense over the lease term, usually on a straight line basis. We're gonna discuss that in the example. It's gonna be easy for you to understand this sentence with an example. This is the journal entry that you're gonna do in the operating lease. You're gonna debit your rent expense and credit the cash. And if you're not gonna pay the cash, you're gonna credit the rent payable. Let's see what the master says here. The master says operating lease expense. The master means the rent expense must be recorded equally over the life of the lease. What do we mean by equally here? He means that you're gonna debit your rent expense with a fixed amount each month. Okay, how can we do that? We're gonna use this formula. You're gonna take the total rent to be paid and underline to be paid because it's really important. The total rent to be paid, and divide that by lease life in months. We'll give you the monthly rent expense. The monthly rent expense. Let's see our first example here. Hassoun Company enters into a 3-year operating lease. 3-year agreements. 3-year operating lease agreements. Starts January 1st, 2020. The lessee will pay on the first day of each year the following. On the first day of 2020, he's gonna pay $25,000. On the first day of 2021, he's gonna pay $30,000, and at the first day of 2022, he's gonna pay $35,000. What is the journal entries for the first year? Is asking you about the journal entries for the first year. In 2020, at the beginning of 2020, I'm gonna pay $25,000 in cash, right? So my credit side is the cash. So what is my debit side? My debit side here is prepaid expense. So let's see our journal entries. At the beginning of 2020, we're gonna debit the prepaid rent expense and credit the cash with $25,000. And this prepaid expense will be amortized over the life of the lease. So let's see how can we amortize it. First, you need to know what is your monthly rent expense. What is your monthly rent expense? How can I get that? Let's go back to our equation. We're gonna take the total rent to be paid divided by the lease life in months will give you the monthly rent expense. So the total rent to be paid, I'm gonna say $25,000 plus $35,000 plus $30,000 will give you $90,000, and you're gonna put in the denominator the lease life in months. So how can I get that? He told you that the lease term is 3 years, so you're gonna take 3 multiplied by 12 months will give you 36 months. So my denominator here is 36. Will give you the monthly rent expense, $2,500. So each month I'm gonna debit rent expense with $2,500. So you're gonna debit the rent expense and credit what? Am I going to pay a cash? No. I have a prepaid rent expense here, so I'm gonna amortize that. So I'm gonna debit the rent expense and credit the prepaid rent expense, okay, with $2,500. And this is going to be done for the first 10 months. Why? because each month I'm gonna debit the rent expense with 2,500, and we have a balance in the prepaid expense with $25,000. So I'm gonna take $25,000 divided by 2,500 will give me that this amount will only cover 10 months. So this is gonna be done for the first 10 months. So we have another 2 months in the year. What should I do? I'm gonna debit my rent expense with $2,500 again. And what else? What should I credit? You're gonna credit your rent payable. Why? Because I'm not gonna pay any cash and my prepaid expense balance now is zero. So I'm gonna credit the rent payable with $2,500. Let's see our second example here. On January 1st, year one, a company entered into a lease agreement for a building. The lease is an operating lease. He told you that it's an operating lease, so and is fully executed on that date. And it means that the lease starts on January, so you're gonna have an expense in January, right? With a payment of $1,000 per month to begin on July 1st. So he's telling you that the payments, I'm gonna start paying the cash on July. So January, February, March, April, May, June, we have 6 months. I'm not gonna pay a cash in them. So I'm gonna debit my rent expense and credit what? My rent payable, okay, for the first 6 months. But with what amount? Let's see, let's back to our information. I'm gonna pay a $1,000, okay, and the payment starts on July, and the lessee will pay that amount in cash for 54 months. So I need the total rent to be paid. How can I get that? I'm gonna take the $1,000 and multiply that with our 54 months. We'll give you the total rent to be paid with 54,000. Okay, and I'm gonna divide that with the lease term in months. So I need the years. The lease term is 5 years, so I need to convert that to months. So I'm gonna take 5 and multiply that with 12 will give you 60 months. So I have the lease life in months. So I'm gonna take the total rent to be paid, $54,000, divided by 60 will give you the monthly rent expense was $900. Okay, so each month you're gonna debit your rent expense was $900. So you're gonna debit rent expense was $900, and in the first 6 months we're not gonna pay a cash, so we're gonna credit your rent payable was $900. For the next 54 months we're gonna credit the cash. We're gonna pay each month a $1,000, but your debit side will have a rent expense with $900. Sorry, with $900. That 900 is fixed. My rent expense will always be $900. So what is the difference? My credit side has a 1,000 and my debit side has a rent expense with 900, so it's not balanced yet. So you're gonna debit the rent payable, okay, with the difference, and it's $100. Okay, Now we're gonna talk about the leasehold improvements. A leasehold improvement is permanently affixed to the property and reverts back to the lessor at the end of the lease. If the property is not movable from the building by the tenant, it's a leasehold improvement. For example, the tile. If you've leased an apartment and you found out that you didn't like the tile, so you decided to change the tile. Um, so it's a leasehold improvement because at the end of the lease, you're not gonna take the tile with you. You're gonna leave the apartment and the tiles in it. Okay. So if the property is not movable from the building by the tenant, it's a leasehold improvement, such as, for example, what? The tiles. Leasehold improvements should be capitalized and added to the PP&E section of the balance sheet. Yeah, we're gonna have an asset called leasehold improvement, and it's going to be amortized over the lesser of, the lower of the lease life or improvement life. Lesser or lower of the lease life or improvement life. This is our general rule. Leasehold improvements should be depreciated or amortized over the lessor. Okay, we're talking about the lessee's perspective. So lessee, lessor, okay, over the lessor of the lease life or improvement life. Let's see an example. In January 2020, Hassan Company incurred a landscaping cost of $120,000 to improve leased property. Its estimated useful life is 15 years. The remaining lease life is 8 years. So we have the estimated useful life for the improvement, and we have the remaining lease life with an option to renew the contract for additional 4 years. Okay, let's keep reading. The managers hasn't decided yet if they will take the renewal option or not. So there is no decision has been made if we are going to take the renewal option or not. So it's just a distractor information. Okay. What should be the net carrying amount of the landscaping costs in Hassoun's December 31st balance sheet? Okay. We have an improvement life with 15 years, and the lease life is 8 years, and the general rule is I'm gonna amortize the the improvement life. I'm gonna amortize the leasehold improvement over the lesser of the lease life or the improvement life. So I'm gonna take the lesser of these, and the lower here is the lease life. So I'm gonna take leasehold improvement divided by the lease life will give you $120,000 divided by 8 years will give you $15,000 per year. So each year I'm gonna amortize that amount from the leasehold improvement. Our balance sheet presentation at the end of the year, of course. Our balance sheet presentation at the end of the year, of course, is we have a leasehold improvement. Its gross amount is 120,000, and the first year amortization is $50,000. So the net carrying amount at the end of the year is $105,000. So the net carrying amount is $105,000. So the answer is B. Let's see another example here. Soon company entered into a 5-year lease agreement with Zico company. The lessee paid an additional 5,000 non-refundable lease bonus to Zico upon signing operating lease contract. So there is an additional non-refundable lease bonus. We're gonna discuss the lease bonus later, and the lease bonus is a prepaid expense for me, but in this question he's asking you about specific information. What he wants from me here: when would Zico recognize an non-refundable lease bonus as an income paid by Hassoun? I know that Zico in this example is a lessor, and I said at the beginning of the video that we are concentrating on the lessee's perspective today. Um, but it's a little bit easy to understand this example. Um, the lease bonus is a prepaid expense from the lessee's perspective and unearned revenue from the lessor perspective. And the rule is simple: the lease bonus must be amortized over the life of the lease. This is the information that I want you to know from this example. It will be recorded as a deferred revenue and amortized over the life of the lease. Okay, this is the information that I want you to know: over the life of the lease, by turning the unearned revenue to unearned revenue. Okay. Let's see another example here. On June 1st, year 1, a company entered into a lease agreement for a building. The lease is an operating lease and is fully executed on that date with a payment of $28,900 per month to begin on October 1st. And the lessee will pay that amount in cash for 56 months. The lease term is 5 years. What is the rent expense for year 1? He's asking you about the rent expense for year 1, the whole year. Okay. I know that the contract is fully executed on June 1st, but I'm gonna pay the cash on October 1st. So my first payment is on October. So we have June, July, August, September. We have 4 months that we're not gonna pay any cash in them. So the $28,900 are not your rent expense. So you have to adjust that amount to find the rent expense that you're gonna put in your debit side. Okay, how can we do that? Again, I'm gonna take the total rent to be paid, divide that with the lease live in months. So how can I get the total rent to be paid? I'm gonna take $28,000 and $28,900 and multiply that with what? With my number of payments. From where did I get the number of payments? And the lessee will pay that amount in cash for 56 months. So I'm gonna multiply that with 56. Will give you the total rent to be paid. Okay. And this is my total rent to be paid. What is the lease life in months? The lease term is 5 years, so you're gonna take 5 times 12 will give you 60 months. So I'm gonna divide that with 60, will give you the monthly rent expense. Okay. We have June, July, August, September, October, November, and December. We have 7 months in the first year. So I'm gonna multiply the monthly rent expense with 7, will give you the rent expense for the first year. Okay, $188,813. Our next bullet here is lease bonus and the non-refundable security deposit. And I want you to be careful. If it's refundable or non-refundable. If it's non-refundable, it's like the lease bonus. It's a prepaid expense and it will be amortized over the life of the lease using the straight line method. But if it's a refundable security deposit, so it's a receivable for you. Okay, we have an example. We have an example about it later. Let's read it. Lease bonus and the non-refundable security deposit are prepaid expenses and will be amortized using the straight line method over the life of the lease. Okay. Okay, let's see this example here. Hassoun is renting prime store space at a mall and signed a 5-year lease contract. Starts on January 1st, year 1, and the following information is provided. We have a refundable security deposit with $1,500, and the refundable security deposit is a receivable for me. And at the end of the lease, I'm gonna take that money back if there is no damage in the property. Okay. Monthly lease payment was $3,000. Lease bonus paid at the beginning of the lease was $18,000. Hassoun incurred improvement costs of $50,000 and its useful life is 8 years. What is the total expense that Hassoun will incur in year 1? Where is the question mark here? Sorry guys, I forgot the question mark. Okay, he wants the total expense that Hassoun will incur in his first year. Okay, what do you think the expenses here? Does a refundable security deposit is an expense? No, I told you it's a receivable. It's not an expense. Okay. And we have an example about the refundable security deposit. So it's a receivable. So it's just a distractor information here. He's asking you about expenses. My monthly lease payments. Yeah, the monthly lease payments here equals the rent expense. Okay, because I'm gonna start paying the cash on January 1st. Okay, so I'm gonna debit my interest, my rent expense, and credit the cash for each month. There is no additional calculation is required here. So the $3,000 is my monthly lease expense, and the lease contract starts on January 1st. So I have a whole year. So I'm gonna take the $3,000 multiplied by 12 months will give you $36,000, and this is your lease payment and this is your rent expense. Okay. Lease bonus paid at the beginning of the lease. We said that the lease bonus is gonna amortize over the life of the lease. So I'm gonna take the $18,000 divided by the life of the lease. He told you that's a 5 year lease contract, so the life of the lease is 5. So the lease bonus, I'm gonna take $18,000 divided by 5 years will give you $3,600. This is the second expense. There is an improvement cost. Of course, the improvement is going to be capitalized and amortized over what? The lesser of the improvement life or the lease life. I told you that the improvement life is 8 years and the lease life is 5 years. So I'm going to take the lesser, the lower of. So I'm going to take $50,000 divided by 5 will give you $10,000. This is the expense for for the first year from improvement amortization. So I'm gonna say 36,000 plus 3,600 plus 10,000 will give you the total year one expense with $49,600. Okay. The refundable security deposit. I told you that the refundable security deposit is a receivable. Will be recorded as a receivable by the lessee until refunded by the lessor. Let's see what the lessor would say to the lessee here. The lessor would say, as long as you do not damage the property, you will get your money back. This is what the lessor would tell the lessee. For example, if the lease agreement included a $10,000 refundable security deposit, the journal entry will be as follows. So, refundable security deposit, I told you it's a receivable, so I'm gonna debit receivable and credit the cash. I'm gonna pay the $10,000. So at the beginning of the lease, I'm gonna debit security deposit receivable and credit the cash with $10,000. And at the end of the lease, if there is no damage to the property, so I'm gonna receive my money back. So I'm gonna debit the cash with $10,000 and credit the receivable with $10,000. We have something called a rent kicker. That is what they call. Actually, it's an additional rent. The rent kicker is a prepaid. Is a period expense, and it's a percentage of their sales when the sales exceeds a certain amount. For example, you're going to pay $10,000 each month as rent expense, but the landlord would tell you if you're making more than $500,000 per year, I'm gonna take 5% out of the additional proceeds over the $500,000. Okay, so this is the additional rent, or what they call a rent kicker. We have an example about it. Let's see it. On January 1st, Year 1 Hassoun Company signed a 10-year operating lease for $96,000 per year. The lease included a provision for additional 5% rent if the company's sales exceed $500,000. Okay. Hassoun sales for year one were $600,000, so it exceeded the 500,000 was what? Was $100,000. So he is going to take a 5% out of the additional proceeds, the $100,000. At the beginning of the lease, Hassoun paid $24,000 as a bonus. So we have a bonus, we have a rent kicker, and we have our rent expense. Okay. What is the expense that Hassoon company incurred at the end of year one? I told you that $96,000 per what? Per year. Okay, because we use that, we used to have a monthly rent expense. We're gonna take the monthly amount and multiply that with 12. But in this example, he's giving you the annual rent expense. Okay, so my base rent is 96,000, and the additional rent is what? I'm gonna say $600,000 minus the $500,000 will give you a $100,000. This is my additional proceeds, and I'm gonna multiply that with what? With my 5% will give you the additional rent was 5,000. Okay, and he told you that there is a bonus of $24,000. That bonus will be amortized over the lease life. Where is the lease life? He told you he signed the 10-year operating lease. So the lease life is 10. So I'm gonna say the bonus 24,000 divided by 10 years will give you $2,400. So I'm gonna take 96,000 plus 5,000 plus 2,400 will give you what? The total expense that Hassoon company incurred at the end of year one. 100,000, 103,000, and $400. Okay. This is for today. Thanks for watching, guys. I wish you enjoyed the video, and see you in capital lease video. See you next time.